This is the last video on variance analysis that I'm going to be making. And the last part we'll be looking at is doing a further analysis on sales variance. Recall that we've looked at sales price variance and sales volume variance. What we want to do is to further analyze the sales volume variance. So we're going to be doing a further analysis on sales volume variance. And I'm sure you can remember that for price variance, we said is about checking whether we have been able to sell our product at a different price than we plan to sell it. So when we did the price variance, we said is equals to, that would be actual price minus the standard price, what we plan to sell, multiplied by the total quantity that we sold, and that's actual quantity. And we said for volume variance, because volume affects not just the revenue but also the cost, we said it's going to be valued at standard margin, and that can be either profit or contribution, whichever one that is available in the question you can use. If both are available, please use profit. But if only contribution you can see in the question, then you can use the contribution. And what is volume looking at is about what volume did we sell compared to what we plan to sell, right? So did we sell different quantity? So that is actual quantity that we sold minus the standard quantity that we plan to sell. This was what we've dealt with this part fully. Now, what we want to look at now is this volume part. The same way when we're talking about usage, that we're able to further analyze material usage into material mix and material yield, is exact same thing we want to do to sales volume. And the first part is the sale mix, and the second part is the quantity variance. So this quantity variance is the same thing as what we used to call the yield variance when we looked at the material usage further analysis. Yeah, it's the same approach, the same formula, it's just different name. So let me take the sales mix quickly. So for sales mix, what we are saying is that what will be the impact of selling our products at a different proportion from what we plan. So remember, when a company is selling more than one product, that is when this mix and quantity for the analysis type of variance is relevant. Okay, so we have more than one product, and if we have 2-3 products, we will plan the way we want to sell them in terms of quantity, and that quantity will give us the standard percentages, which is the standard proportions of how we plan to sell those products. However, that would not necessarily be the actual. So when we do the sales mix variance, what we are checking is what will be the impact of selling those products at a different proportion, and would that effect be good or bad? Yeah, so which is similar to what we did in usage mix when I introduced one column, which is the same thing I'm going to do here. And that column is usually the actual quantity at the standard percentage. So it's the same total actual quantity that we're going to be apportioning into the different products based on the standard percentage. And this is a new column that we're introducing. So which means if we compare this versus the actual real quantity, and we value it at the standard margin as we always do, that is sales mix variance. However, if we are comparing this same one with the standard quantity, remember, still valuing at standard margin, this is what we call the quantity variance. And this quantity variance is the same thing we used to call the yield variance under the material usage analysis. I'm going to use a question to even explain this further, but this is just like an overview of what we're talking about. But I'm going to use a question to explain. So let's look at this question. Very good question, Deco. So they've given us the budget information and they've given us the actual. Yeah, the total unit we plan to sell is about 4,000, and eventually we sold 4,250. Take your time to look at the question. We have the selling price actual, we have the standard selling price and the standard cost for each product. There are two products involved here, Zen and Mean. Remember, two products at the minimum for you to be talking about mix variances. All right, so that's what they want us to calculate: sales mix and quantity variance. Remember what I said about sales mix? It's about you asking this question: what is the impact of selling this product at a different proportion from planned? Because we have sold it at a different proportion. So let's even find out what's our standard proportion for each of these products. So standard percentage. So for Zen, the plan is 1.5 out of 4,000. So that is 1.5 over 4,000. And that will give us 37.5%. And if we do the same thing for Mean, that will be 2,500 over 4,000. And that is 62.5%. So these are the standard percentages. Yeah, so, but have we sold at the standard percentages? No, because the actual percentages, if we do the same thing, we plan to sell 37.5% of total units sold for Zen. Eventually, we did 47%. We plan to make sure that out of the total quantity that we're selling, 62.5% will be Mean. That was our plan, but the actual was actually 53%. So remember what I said. The most important thing is to remember that column that we are introducing, Z and Mean. So that column is the total actual quantity at the standard percentage, because we're saying, what if we had stuck to our standard percentage? And that standard percentage is 37.5% of Zen. So if you multiply that by actual total, which is 4,250, we'll have 1593.75. The same thing if we do for Mean, that will give us 2656.25. And this is usually the new column that you always have to add, which must give us 4,250, because it's this 4,250 that we analyzed based on our standard proportion. So this is what we have to compare with our actual quantity. And the actual quantity is 2,000 for Zen and 2,250 for Mean. We know we have to value at standard margin, which is standard margin is a 50 price minus standard cost of 40. So 10 for Zen and 20 for Mean. With this, we're good to go for the variance. Because variance will be this compared with this value at this. So invariably what we're saying is that for Zen, it will be equals to the actual of 2,000 minus 1593. If we had stuck to the standard percentage, this is what we should have sold. And we'll value at 10. And that will give us 4062.5. And because the actual is more than the standard, then that is favorable. The same thing we'll do for Mean, we'll get minus 8125. However, the actual is less than the standard, and that will be adverse. And the net mix that we're having will be negative 4062.5. And surely this is adverse, because we have more adverse than favorable. So the net is 4,062 adverse. Yeah, so which means for sales mix, it's adverse of $4,062. Yeah, and how do we interpret this? The starting point is know that overall we are worse off by not sticking to our planned percentage because the net mix is adverse. Remember, mix is asking, are we better or worse by not sticking to our standard percentage? So overall, we are worse off. Yeah, because the plan was to sell these items in 37% and 62%. But let's see the actual percentage. How did we sell them? So we're supposed to sell 62%, or approximately 63% of mean by our plan, and we're supposed to sell approximately 37% of zinc. But instead, we sold 47. We sold 53. So we sold more of zinc, but less of mean. And now we can see why we are having this problem, because what has happened is that we sold more of zinc, and zinc has a worse margin. That is just 50 minus 40, 10, compared to mean that has $20 margin. Yeah, so in summary, what we're saying is we sold more percentage, yeah, which is 47% of zinc with worse margin, just $10 than the planned percentage. The planned percentage was 37%. Yeah. You can see. So if we are ever going to be better, we should be selling more percentage for a product that has a potential higher margin, not the other way around. But maybe it's not within our control. We have to find out. Yeah, so the question is, why? Why did we struggle to sell more of a product that has $20 margin? Yeah, a product that promises to give us higher margin. Why didn't we sell more of that? So we need to find out. Did we run into troubles? What happened? Yeah, there's a possibility, because remember, when you do this analysis, you need to think about possibilities, because not necessarily going to be actual all the time. So the first possibility is the fact that zinc and mean might actually be substitute products, might be similar products, which means they are able to give similar satisfaction to customers. So what I mean that it might be substitutes. And if they are substitutes, it means that definitely customers will prefer to go for a cheaper product. So which means cheaper Z will be bought. That's zinc at $50 will be preferred. So it might be the reason why all the customers are tending towards buying Z, because it's cheaper, $50, compared to mean that is sold at $80. So that might be the major reason why we have been forced to sell more of zinc than mean. That is mix, sales mix, but we cannot conclude yet. Let's look at the quantity variance, which is like the yield. And remember what I told you? This column will remain important. That's the same column I'm going to bring down now. And we're going to have the standard quantity, because this time around we have to compare with the standard quantity, which is our budget. And that is 1.5 and 2.5. Valuation always at the standard margin. And we know the margin to be 10 and 20. We'll calculate the variance quickly. For Z, we have 937.5. And because standard is 1.5, but our actual standard proportion is more, so this is favorable. And for mean is similar, 312. To 5. And this one too more than the standard, so this is also favorable. And if we add everything together, it's definitely going to be all favorable, and that is 4062.5. So that's a favorable variance for the quantity variance. And why? Because we sold more. We're able to sell more, so we sold more quantity. Talking about our actual quantity of 4250 here. So we sold more quantity, 4250, than we planned. We planned to sell total 4,000. So we have been able to sell much more quantity. But the question is, why are we able to sell more quantity? Is it because we are marketing very well? Is it because we are excellent? Or is it just the market that is growing? And that brings me to these two possibilities and the next type of variance that we're going to look at. Because this why of being able to sell more quantity can either be due to increase, or let me just say a change in market size, which means the market has grown by itself. We have new customers coming into the market, so we're able to get more customers. Or change in market share. So which means we've been able to convince more customers that were not ours before. We have been able to convert them from our competitors to become our own customers through our promotion, marketing, and other activities. And that is our own effort. So we see that if your market share is able to increase, that is your own effort, company's effort, and should be praised for it. But if it's about market size, that is external and it's not our effort, it's just by luck or chance. So we need to find out why is our market size or market share changing. And that is the next type of variance that we want to learn. And that is talking about market share and market size variance. And the first step you need to do in this circumstance is to revise the sales budget volume. So we need to calculate a revised sales budget volume. And I will explain what it means. And that will be based on the new market size. New or actual, we can call it actual market size. Yeah, because what we're saying is that, okay, when we did a budget, we expected the market to have a particular size. So our budget would have represented a particular proportion of the market. So if we are able to sell the same proportion in the market, that means we have kept our market share. But if the actual volume, the actual quantity that we sold is different from the revised volume based on the new market, then that means our market share has changed. So what I'm saying in summary is this. Actual volume is what we sold. If it is not the same as the revised volume, remember, you will revise the volume based on the size of the market. If this happens, then what you are saying is that there's a change in market share. So that means the market share has changed. Let me just use a quick scenario to explain this. Let's assume that we budgeted 100. And when we budgeted 100, the total market is at say 200. This is total market. What this means is that we have 50% of the market. So this is our market share. So if this is our budget, and now the actual happens, and the market size has become, let's say, 220, it means that the market has changed. Yeah. Leave the market growth for now. I'm coming to that. Yes, I can see market has grown, but I want to explain this market share first. Normally, what you expect our actual to be when the market has gone to 220, if we are going to maintain this market share of 50%, you expect it to be 110 because that's the 50% of 220. So actual should be 110 in this type of market because the revised budget based on this market size will be 50% of it because when we did the budget, it was based on 50%. So which means our revised budget will be equals to 50% of 220, and that will be 110. And if this actual is 110, then we have maintained the market share of 50%. But what I'm saying is that if this actual is any figure different from 110, take for instance, let's say it's 120. It means the actual volume of 120 is no more equals to revised volume of 110. And that is an indication that there is a market share changing. So market share has changed. And you will see that the market share has changed to 120 divided by 220. And that is giving us 55%. So you can see the market share has increased to 55%. That's what we are saying. And that is what we'll be learning as we move on. I'm going to use a question to also explain it. That's for the market share variance. But remember, there can also be market size variance that we need to also understand, which might also be responsible for the difference in actual volume sold and the planned volume. And this market size is very straightforward. What we're saying is that if budget volume is not the same as the revised volume, then that means the market has grown. Because when we budgeted 100, market size was 200. So budget is 100. Remember in my example here. So what we're saying is that when market has grown to be, we said in this example, 220, which means our revised budget that we got it to be 110. So for us to know whether the market has truly grown, then we need to compare our budget volume versus the revised volume. And if they are not the same, then the market has changed. And as you can see, 100 is not the same as 110. And you can see for sure the market size has changed. That is why. And that is why when we are calculating all these variances, those are the two things we'll be comparing. So take for instance, to calculate your market share variance, we're going to be doing actual volume minus revised volume, and we'll value at the standard margin. And likewise, for market size variance, we'll be doing budget volume minus revised volume multiplied by the standard margin. Very straightforward. Let's try and let's do an example to just understand this better. Look at this question. We have the budget information here. This is the budget, and this is the actual. Now let's calculate the market share and market size variances in this situation. Yeah, remember what we said. I said step 1 is to calculate your revised budget volume. That is because that is the only thing you are introducing here. Revised budget volume based on your actual market size. If you look at this question, you discover that the actual market size is 900,000 units, whereas when the budget was made, it was based on market size of 1 million units. So which means market has shrunk actually from 1 million to 900,000. Now, what's our current market share? So current market share, or the budget, we're talking about the budget, based on the budget, is actually 10,000 divided by 1 million, and that is 1%. So this is our standard market share. That is what we expect. So which means that we need to revise our budget volume based on that. So our revised budget volume, sales volume, based on the reality of the new market, should be 1% of 900,000, because market is now 900,000. So our budget should actually be 9,000 units of sales. And remember what I told you, once this figure is different from actual, as you can see, it's different. There's issue with market share. And once this figure is different from the budget, there's issue with the market size. So both of them are different. And now we need to calculate the exact figure for this. Because what we're saying, in reality, in this current market that we are, we should be selling 9,000. We should be selling 9,000. So to see what's going on with market share, so market share variance now, we look at why we're not selling 9,000. So market share variance, and definitely that will be comparing our actual quantity minus revised quantity. And we're going to be valuing, as usual, at standard margin. So actual quantity, 8,800. Revised, 9,000. Standard margin, 15 minus 8, that is at $7. So that will give us, that's 200 times 7, that's 1,400. So we should be selling 9,000, but we only sold 8,800. So that is adverse. Sorted first. Now, if our revised budget volume is less than original budget, then definitely market must have shrunk, and vice versa. Because if our revised budget is more than the original budget, then that means market has expanded. Right. So let's look at the size variance to see whether the market has expanded or has shrunk. And this time around, we'll be comparing our revised budget, which should be what we should achieve, less the budget volume, and also valued at standard margin. So which means our revised is 9,000 less 10,000 that we budget. You can see 10,000 is budget, revised 9,000. Valuation will still be at 7. And now we can see that we budgeted 10,000. However, market has gone against us. Market has shrunk by itself, and that has reduced our achievement to the maximum of 9,000. So which means it's not what we want to see. Reduction in market size is not what you want to see. You want to do a lot. You want to be able to sell more. So this is definitely going to be an adverse, because 9,000 minus 10,000 is 1,000 times 7. So that is 7,000 adverse. So which means both the market share and market size are both given adverse variance. And now we can explain what is going on. So think about it. What's our budget? We budgeted 10,000 unit sales. But actual actual sold was actually 8,800. Now we can explain what is going on here. So our budget of 10,000 was not achieved for sure, obviously. We only sold 8,800. And what we are saying is that this deficiency of how much, about 1,200 that we are not able to make, can be explained due to two things. This volume short, yeah. We are short by this volume. There are two things that is responsible. Number one is the fact that market shrunk. Yeah, market shrunk. And because market shrunk, we had adverse of 7,000. So this is actually the major reason. So that's a lot, 7,000. Yeah, and also, we didn't do so well. We lost some customers. So despite the fact that the market is declining, market is shrinking, we are still losing even our customers. So we lost market share. And that resulted into 1,000 adverse. I mean, not so much effect like the size effect, right? So what we're saying is that the volume shortage that we have in our sales is partly our fault and also partly not our fault. But now we have the full view of what is going on. Because remember, the overall volume variance that we're trying to split, you can calculate it as actual minus your budget. So that's 10K minus 8,800, valued at the margin of 7. Yeah, that is 1,200 times 7, and that's equals to 8,400. And definitely, this is adverse because you budgeted 10,000, you only sold 8,800. This 8,400 is what we split up there into 7,000, this one, and 1,400 adverse here. Yeah, about this 4K is 1,400, just to put it here. Yeah. Yeah, so that's split into 7,000 and the 1,400 adverse. This is from the shrinking market, and this is from the loss of market share. That is the analysis that you're trying to do. Yeah. Okay. So, but now we know why we are not able to sell as much as we ought to sell. However, why did we lose this market share? I mean, we might not know why the market is shrinking. Maybe there's recession. There might be so many reasons. Maybe the product is going out of existence, maybe maturing or declining. There may be a lot of reasons. However, our own market share, why are we losing more customers than necessary? We can quickly check our price variance to see what is going on. To see whether are we charging more. And you can see we're supposed to be charging $15, but look at the actual. We charge $16. So which means this is basically due to higher price being charged, because this will definitely give us a favorable price variance, which we can quickly check. Remember, our price variance is about did you sell at a price different from plan. So 16 minus 15, and what we sold, that's actual quantity of 8,800. And that will give you 8,800 favorable. So actually, we have a favorable variance from the price. Yeah, because we're able to charge high price. And definitely, this might be the reason why we lost some customers, because we are charging higher price. Yes, variance analysis is fantastic, but there are a couple of environments where it is usually not the best. If you talk about total quality management environment, maybe also a rapidly changing environment, or even JIT, yeah. All of this environment, variance analysis might not be your best option. Yeah. be limited. You have to combine other measures to really be able to do your performance management properly. Because think about it, in a total quality management, you want to get it right the first time and all the time. So which means wastage is not acceptable. You're not going to be expecting wastages. Remember, in variance analysis, you are going to be considering wastages as part of your standard, right? This is not acceptable in TQM, because in TQM, you are expecting continuous improvement. Yeah. So what it means that variance analysis will have a lot of limitations there. Likewise, in a rapidly changing environment, there are also challenges with variance analysis, because it's an environment where what you want to focus on is more like adaptation. That is what you want to be measuring. How are we adapting quickly? How are we responding quickly to our customers? So speed to response is also very critical. So speed to respond to customers' need will be very important. So it's not just variance analysis of, what did we sell? How much are we supposed to sell? That's not what we want to be looking at in a rapidly changing environment. Because in fact, you might have adverse variance analysis and you might be doing well, because you're going to catch up at a point in the future, because you are able to satisfy the customers as their needs are changing. And before you know it, you might start getting even more customers to the point where you are able to make more money. But if you are just being stuck on variance analysis, you might just say, we're not doing well, and what's next? People will be demotivated because they are putting in their best, but you are not praising them. Likewise, in JIT, you are buying raw materials only when there is order. So there might be volatility of price, because if you are just going to buy when you need it, you might be under pressure, and which means pricing might not be at the best for you. But does that mean that you are doing badly? Not necessarily, because your plan will mostly going to be totally different from your actual, depending on your reality. So all of these things might actually cause your employees to behave in a negative way if you don't take all of this into considerations. And that is why you see, take for instance, for price variance, in trying to achieve favorable price variance, your employees might behave in two different ways. That's why I'm going to summarize it. They might exhibit good behavior, which means what they are trying to do is to negotiate better. If they are happy, they will try to negotiate better. Or they might even try to redesign the product such that consumption of material can be minimized. Or more efficient way of using material or something. Or maybe use a product that requires a cheaper material and still deliver the same quality. However, they can also exhibit bad behavior if they are not happy, if they feel like they are being assessed based on measures that are outside their control. They might exhibit bad behavior, and in this case, what you see them doing is that they will buy fake materials, less quality. They buy fake materials, and you don't want that. And likewise, if it's talking about labor variance, in trying to achieve favorable labor variance, they can actually also behave in a very responsible way, which is trying to see how they can improve their process, so they can go for improvement in efficiency. That is good. That's what you want to see. But if they are not happy, if they think they are being measured based on criteria that are outside their control, they will never try to get better. They will never want to get better. So, which means they will never want to beat the target, because they believe that if they beat the target, you set even tougher target the next time. So, which means they will not, continuous improvement is not their thing. But here, they will be promoting continuous improvement. So those are the kind of behavior challenges you can have with variance analysis. And please, that will be the end of it.